trade that hurts you most is often the one you took simply because nothing else was happening. You did not see a clean signal. You did not have a strong reason. The market was quiet, your screen was open, and the silence began to feel like a challenge. So you found something to do. That is where a trader begins to pay for boredom without realizing he has entered a position. This is one of the quieter costs in trading. It does not announce itself like fear. It does not rush through the body like greed. Boredom sits still, waits patiently, and convinces you that discipline is the same thing as missing out. It makes inactivity feel irresponsible. It makes a weak setup look acceptable simply because it is available. You must understand this clearly. The market does not reward activity. It rewards judgment. A trader can be busy all day and make no real progress. He can click, adjust, chase, reverse, add, reduce, and still be doing nothing more than feeding a need for motion. The account may move, the emotions may move, but the reasoning has stopped. When price is moving sharply, the danger is obvious. You know you are being tested. But when price is slow, mixed, or dull, the test is more subtle. You begin to lower your standards. You stop asking whether the trade is right and start asking whether it is good enough. That small change in language is not small at all. It is the beginning of compromise. A serious trader watches this moment carefully. He notices when he starts drawing lines that were not important 10 minutes ago. He notices when he checks smaller time frames just to find movement. He notices when a planned trade becomes a forced trade. These are not harmless habits. They are evidence that boredom has begun to make decisions on his behalf. The market often spends more time preparing than performing. It builds pressure, absorbs orders, traps impatient participants, and waits for one side to reveal itself. If you cannot endure that preparation, you will often enter before the real information appears. Then, when the true move begins, you are either already wounded, already biased, or already exhausted. This is why boredom can become an edge. Not because boredom is pleasant, but because it exposes what other traders cannot tolerate. The impatient trader needs action, so he creates it. The careful trader studies that need for action and lets it become information. When the market is dull, you are not only watching price, you are watching the behavior of people who cannot wait. You begin to see rushed breakouts. You see false momentum appear where no real pressure exists. You see traders enter late into thin movement because the absence of opportunity has made them hungry. When those positions fail, they often fail quickly, because they were never built on strength. They were built on discomfort. Your task is not to eliminate boredom. Your task is to stop obeying it. That begins with a different relationship to waiting. Waiting is not empty time. Waiting is where standards are defended. It is where you protect capital from weak ideas. It is where you allow the market to separate noise from intention. The trader who cannot wait is forced to accept whatever the market offers first. The trader who can wait is allowed to choose, and choice is the beginning of edge. The first thing boredom exposes is not the market. It exposes your relationship with stillness. You sit in front of the screen, price is barely moving, and nothing appears to be wrong. No panic, no loss, no obvious danger. Yet something inside you begins to tighten. The quiet becomes uncomfortable. You start to feel as if the market is withholding something from you, as if time itself is working against you. That feeling matters, because it tells you that your need for action may be stronger than your need for truth. A trader often mistakes boredom for a lack of opportunity. But boredom is not created by the chart alone. It is created by the mind that wants the chart to provide stimulation. When price is moving, the mind has something to follow. When price is still, the mind is left alone with its own expectations. That is when the real test begins. Not because the market is difficult, but because there is nothing obvious to fight. This is why boredom can feel more dangerous than fear. Fear usually has an object. A position is moving against you. A stop is near. A loss is becoming real. Boredom is less honest. It has no clear enemy, so it looks for one. It may tell you that you are wasting the session. It may tell you that a serious trader should be doing something. It may tell you that patience is laziness dressed in discipline. But the market owes you nothing for being present. It does not pay attendance. It does not reward the number of hours you stare at price. This is hard for a developing trader to accept because effort in most areas of life is visible. More work often creates more output. In trading, more internal pressure often creates worse judgment. The more you demand movement from a quiet market, the more likely you are to see meaning where there is only noise. You must watch the moment when stillness begins to feel personal. That is where boredom gains power. The market is not ignoring you. It is not testing your worth. It is not proving that you are late, slow, or missing out. It is simply not offering what you want at the moment you want it. If you interpret that silence is rejection, you will begin trading to repair a feeling instead of reading conditions. Ask yourself plainly when nothing is happening, do you feel calm or do you feel accused? That question cuts deeper than it first appears. If quiet price action makes you feel unproductive, then your confidence depends too much on movement. If an empty session makes you feel foolish, then your identity is tied too closely to being active. If waiting makes you restless, then your discipline is still conditional. It works when the market entertains you, but weakens when the market gives you nothing to respond to. This is not a small matter. A trader who cannot sit through boredom becomes vulnerable before any trade is even considered. His state changes first. His standards change later. The mind searches for relief, and once relief becomes the goal, the chart is no longer being observed cleanly. It is being used. The trader is no longer asking, what is true here? He is asking, what can I do so I no longer feel this way? That shift is subtle, but it is serious. Because once the market becomes a tool for emotional relief, patience feels like pain, silence feels like pressure, waiting feels like failure, and from that condition, almost any movement can begin to look meaningful enough. The work begins before the hand moves, before the ordered ticket opens, before you explain a trade to yourself. It begins in the quiet recognition that boredom is not an instruction. It is only a sensation. You can feel it without obeying it. You can notice the restlessness without giving it authority. You can let the market remain quiet without turning that quiet into a personal problem. This is where discipline becomes less dramatic and more serious. Not the discipline of forcing yourself to be calm, but the discipline of seeing clearly what is happening inside you while nothing much is happening outside you. Once you can separate market silence from personal discomfort, you begin to recover your judgment, and only then can you examine the next danger, what that discomfort does to your execution when you finally decide to act. A trade can be wrong before it loses money. It becomes wrong the moment you enter before your reason is complete. The chart may still look acceptable. The loss may not come immediately. Price may even move in your favor for a while. But the damage has already begun because you acted before the market gave the confirmation your plan required. This is where boredom enters execution quietly. It does not always make you take a wild trade. More often, it makes you take a nearly valid trade. A setup is forming, but not formed. A level is close, but not reached. Momentum is starting, but not proven. The trade feels familiar enough to justify action, yet incomplete enough that you would have passed on it if your patience were fully intact. That is the danger of premature execution. It looks disciplined from a distance. You can still explain it. You can still point to structure, trend, support, resistance, or pressure. But if the exact condition you require has not appeared, you are not trading your method. You are trading an anticipation of your method. There is a difference between anticipation and execution. Anticipation observes what might happen. Execution acts only when what must happen has happened. The weaker trader blurs those two because he wants to be early. The serious trader keeps them separate because he knows early often means exposed. When you enter before confirmation, you buy uncertainty at the price of impatience. This matters because timing is not decoration. Timing is part of risk. A good idea entered too early can become a bad position. You may have the right direction and still suffer because your entry gives the market too much room to move against you. Then you are forced into decisions your plan never intended. Hold through discomfort, widen risk, exit before the actual signal, or watch the real move begin after you have already been shaken out. Boredom also makes movement look more important than it is. A small push begins to feel like momentum. A minor candle begins to feel like a breakout. A slow drift begins to feel like participation. But movement alone is not confirmation. Markets move all the time without commitment. If you treat every twitch as evidence, you will enter trades that have motion but no authority. Watch your hand when price gets close to your level. Watch how quickly you want to act before the trigger is clean. Do you enter because the signal has arrived, or because you fear the signal may arrive without you? That small distinction separates execution from chasing. One is based on evidence. The other is based on proximity. There is another form of weak execution, adjusting size to compensate for a poor setup. A trader becomes tired of waiting, then takes a trade smaller than usual so he can call it harmless. Or he takes it larger because he feels the day has offered too little and this one must count. In both cases, size is no longer tied to quality. It is tied to mood. Once that happens, the order is no longer clean. Clean execution has no need to hurry, decorate, or excuse itself. The trade either meets the condition or it does not. The entry is either where the plan says it should be or it is not. The size is either appropriate for the setup and risk or it is not. This simplicity is hard to maintain because the market constantly offers almost trades, and almost trades are where bored traders spend their money. Your task is to become exact at the point of action. Not rigid for the sake of pride, but precise because precision protects you. Before entering, reduce the trade to its plain facts. What was required? Has it happened? Where is the invalidation? Is the entry still at the intended price, or are you now paying extra because you hesitated and chased? If the answers are not clean, the order should not be either. Execution is the moment where discipline becomes visible. Thoughts can sound professional. Plans can look impressive, but the order shows the truth. When boredom has weakened your standards, the order will reveal it first. And once those extra orders begin to appear, the next question is not emotional at all. It is numerical. What do these small, unnecessary trades do to the system underneath your results? A weak trade does not need to be large to be expensive. This is one of the facts a trader learns late, because the damage often looks small at first. A minor loss here, a scratch trade there, a few commissions, a little slippage, a little spread paid for no real advantage. None of it feels serious in the moment. But trading is not measured by one moment. It is measured by what repeated moments do to the numbers. A sound method depends on selectivity. It may not produce many true opportunities, but the opportunities it does produce have a certain quality. They have a reason, a location, a risk point, and a probable reward that justify the trade. When you add low-quality trades between those better trades, you do not simply add activity. You change the character of the whole system. This is where boredom becomes a mathematical problem. It increases the number of trades without increasing the quality of the edge. If the extra trades have weaker odds, poorer prices, and less defined risk, they drag down the average result. The account may not collapse, but the expectancy begins to thin. A method that should be clean becomes diluted. Think of expectancy as the quiet engine beneath your trading. It is not concerned with how hard you worked, how long you watched, or how badly you wanted a result. It only asks, over many trades, what does the average decision produce? If your best trades carry the system forward, but your bored trades pull against it, then your final result becomes a mixture of skill and leakage. Leakage is dangerous because it does not always feel like failure. A trader may look at the day and say, I only lost a little. But the better question is, did I spend money on trades that had no business being in the sample? Because every unnecessary trade becomes part of your record. It affects your average win, your average loss, your win rate, your drawdown, and your confidence in the method. The numbers do not separate noble intentions from poor decisions. They do not care whether a trade was taken out of discipline or restlessness. Once the order is placed, it enters the ledger. Enough small, unnecessary trades will make a profitable approach appear unreliable. Then the trader begins to doubt the system, when the real problem is that he has polluted the data. This is why trade frequency must be treated with respect. More trades are not automatically more opportunity. More trades are only useful when they come from more valid setups. If the added trades are weaker than the core trades, they do not create growth. They create friction. And friction compounds just as surely as profit does. Commissions are friction. Spread is friction. Slippage is friction. Mental reset after a poor trade is friction, even if it cannot be seen on the statement. The market charges you for participation, and it charges you whether your reason was strong or careless. A trader who takes 10 unnecessary trades may believe he has only risked 10 small outcomes. In truth, he has paid 10 times to weaken his own statistics. You must learn to see the cost before it appears as a large loss. The bored trade usually does not destroy the account in one strike. It works by reducing the quality of the average. It makes the equity curve heavier. It turns clean data into confused data. It makes review harder because valid trades and weak trades sit together as if they came from the same mind. So when the market is quiet, do not ask only, "Can I afford this trade?" Ask, "Does this trade deserve to be included in my results?" That question is stricter. It forces you to protect the sample from contamination. It reminds you that your record should reflect your edge, not every passing urge that reached the order button. A trader becomes stronger when he stops treating small losses as harmless simply because they are small. The size of the loss is only one part of the cost. The deeper cost is what the trade does to expectancy, to clarity, and to the trustworthiness of your own numbers. And once you understand that dull periods can quietly damage the math, the next step is to study the market itself more carefully, because a quiet market is not always empty. A quiet market is not a dead market. It may look still on the surface, but beneath that stillness, positions are being built, reduced, defended, and tested. Price can spend hours moving in a narrow range, and the careless eye sees nothing worth studying. But the market is often most revealing when it appears least impressive. The lack of movement is not always absence. Sometimes it is preparation. When price stops moving freely, it is usually because opposing forces are meeting each other. Buyers are present, but not strong enough to advance price with ease. Sellers are present, but not strong enough to break it down cleanly. The result is compression. Each side presses, absorbs, retreats, and returns. The range becomes a record of conflict, not emptiness. This is why dull price action deserves respect. A market that refuses to continue in one direction may be telling you that pressure is changing. A level that keeps rejecting price may be showing you where supply or demand is being defended. A breakout that cannot hold may be revealing that traders were drawn in too early. These are not dramatic events, but they are information. You must learn to watch how price behaves inside quiet conditions. Does it keep returning to the same high without breaking? Does it dip below a level and recover quickly? Does volume expand at the edge of the range but fail to produce distance? Does price move easily in one direction and heavily in the other? These details show whether the market is accepting prices or rejecting them. A range is not just sideways movement. It is a place where traders reveal their intentions through failure. If buyers push upward several times and cannot gain ground, their inability becomes part of the story. If sellers break a low and price quickly returns, that failure matters too. The market often speaks through what it cannot do. This is where the patient observer gains information that the impatient participant misses. The participant sees delay and wants resolution. The observer studies the delay itself. He watches where price becomes heavy. He watches where it becomes light. He watches which side must work harder to move the same distance. Over time, quiet action begins to show imbalance before the larger move becomes obvious. False moves are especially important in slow markets. When price breaks a small boundary and immediately stalls, it may be testing whether there is real interest beyond that level. If no follow-through appears, those who entered on the break can become trapped. Their exits may later fuel movement in the opposite direction. What looked like a failed opportunity may actually become the clue. The same is true of absorption. Price may strike a level again and again without passing through it. To an impatient trader, this looks like frustration. To a careful eye, it may suggest that one side is taking everything offered and preventing progress. When repeated pressure produces little distance, The market is showing that effort and result are not aligned. Do not demand that quiet markets entertain you. Study what they reveal. Mark the boundaries. Notice where attempts fail. Notice whether breaks hold or return. Notice whether movement expands or dies near certain prices. The purpose is not to predict every turn. The purpose is to understand where pressure is building and where traders are likely to be wrong. Because once pressure has built long enough, the eventual move often carries more meaning. It is no longer just price moving through a line. It is the result of decisions made during the quiet period. Traders who entered too soon must respond. Traders who waited for proof must decide whether the market has finally shown enough. And that brings you to the next question. How do you tell the difference between a market that is quietly preparing and a market that is offering no trade at all? A trader must learn that no trade is not the same as no decision. This distinction is simple, but it changes everything. When the market gives you nothing clean, the weaker response is to feel unfinished. The stronger response is to recognize that standing aside may be the correct action. The absence of a position does not mean the absence of judgment. It may mean judgment has finally taken control. A bad trade often enters through a narrow doorway. It does not always appear reckless at first. It begins when you accept a reason that is almost strong enough. The level is almost right. The setup is almost clear. The risk is almost defined. The timing is almost acceptable. But trading is not built on almost. The market may forgive many things for a while, but vague decisions eventually ask for payment. The question is not, can this trade work? Almost any trade can work. A poor entry can win. A weak idea can be rewarded. A careless decision can produce profit by accident. That is why outcome alone cannot be trusted. The better question is, should this trade be taken according to the evidence I require? That question brings the mind back from possibility to process. A proper decision begins by separating desire from condition. Desire says, there might be something here. Condition says, the required facts are present. Desire is flexible. It adjusts its standards to fit the moment. Condition is firm. It does not care how long you have waited, how close price came, or how tempting the movement looks. It asks only whether the trade exists by your rules. This is where the no trade decision becomes powerful. It protects you from unclear opportunity. It keeps your capital out of situations where the risk cannot be named plainly. If you cannot say where the idea is wrong, you do not have a trade. If you cannot say why this price matters, you do not have a trade. If you cannot explain what has changed in the market since your last observation, you may only be reacting to motion. You need a small gate before every order. Not a complicated gate, but a strict one. What is the setup? Where is the location? What confirms the idea? What invalidates it? Is the reward worth the risk from this exact price? If one answer is missing, the trade is not mature. It may become a trade later, but later is not now. This keeps you from confusing preparation with permission. You may have studied a market carefully. You may have marked levels, watched reactions, and built a reasonable idea. But preparation does not authorize action by itself. The market must still meet you at the point of decision. Until it does, the work remains observation, not commitment. There is also danger in choosing a trade simply because it is the best available option. The best weak trade is still weak. A quiet session can narrow your standards until a poor setup looks attractive only because everything else looks worse. But trading does not require you to select from every market condition. You are allowed to reject the entire menu. This is difficult because a no trade decision gives no immediate proof. There is no profit to confirm you were right. There is no visible victory. Sometimes price moves without you, and the mind wants to punish itself for staying out. But if the trade did not meet your conditions, the move is not evidence against your discipline. It is only evidence that markets can move without offering you a proper decision. You must judge the decision by the information available at the time, not by what price did afterward. Otherwise you will train yourself to worship results and abandon standards. A good no trade can be followed by a large move. A bad trade can be followed by profit. If you cannot separate decision quality from outcome, the market will teach you the wrong lessons. So when boredom presses against your judgment, make the decision visible. Say plainly, "This is a trade," or "This is not a trade yet." That word, "yet," matters. It keeps you alert without forcing action. It allows patience without passivity. It reminds you that the market may develop, but you do not need to commit before it does. A quiet market becomes dangerous when a trader has no assigned work. Empty time will always look for a purpose. If you do not give it one, it will invent one. The screen stays open, price moves slowly, and the trader begins to drift. He checks markets he did not plan to trade. He refreshes charts that have not changed. He looks for something new, not because new information has appeared, but because the session has lost its shape. This is why professional habits matter. They remove the need to negotiate with yourself every minute the market is open. A trader without routine must constantly decide what to do next, and every small decision becomes an opening for distraction. A trader with routine has already decided how quiet time will be used before quiet time arrives. The purpose of routine is not to make trading mechanical in the shallow sense. It is to protect the mind from unstructured attention. Attention without direction becomes hunger. It starts feeding on movement, opinions, alerts, headlines, and minor changes in price. Once attention becomes scattered, judgment becomes less reliable. The market has not changed, but the trader's condition has. A sound routine begins before the session. You define the markets worth watching. You mark the prices that matter. You decide what kind of behavior would be meaningful and what kind would be noise. This does not predict the day. It prepares you to recognize the day. Without that preparation, every small move must be interpreted under pressure, and pressure makes ordinary movement look important. During slow periods, the routine must continue. The work is not to stare harder. The work is to review the plan, check whether price is near meaningful areas, update only what has truly changed, and leave the rest alone. If nothing important has changed, then the correct observation is simple: nothing important has changed. That statement is more valuable than forcing a new opinion every few minutes. A watch list is useful only when it has boundaries. Too many markets invite wandering. Too few notes invite guessing. Each market on your list should have a reason for being there. What condition would make it active? What price would make it interesting? What behavior would make it irrelevant for the session? When these questions are answered in advance, waiting becomes supervised. Alerts can also defend discipline. They allow you to step back from the screen without abandoning the market. If price is far from the area that matters, constant watching often adds nothing. It only increases the temptation to treat small movement as meaningful. A well-placed alert says, "Until this happens, there is no work here." That frees your attention from unnecessary contact with noise. Breaks are part of the routine too. This may seem simple, but it is often neglected. A tired trader does not always feel tired. Sometimes he only becomes easier to persuade. The longer he stares without purpose, the more likely he is to accept weaker reasons. A short break at the right time can preserve judgment better than another hour of forced concentration. Review should also have a place in the session, not only after damage is done. When the market is quiet, you can examine past trades, compare planned behavior with actual behavior, and note whether current conditions resemble days that usually produce poor decisions. This turns waiting into study. The trader is still working, but he is not manufacturing risk to prove it. The key is to separate activity from productivity. Moving through a routine is not the same as taking action in the market. It is the discipline of doing the right kind of work for the condition in front of you. When the market is active, your routine narrows your focus. When the market is quiet, it keeps you from becoming loose. You should know what you will do if no trade appears for 1 hour. You should know what you will do if no trade appears for 3. You should know when to review, when to step away, when to reset alerts, and when to stop pressing the session for meaning. This is not weakness. It is professional containment, because boredom does not always defeat a trader through one obvious mistake. Sometimes it wins by slowly removing structure. First the plan becomes optional. Then the watch list expands. Then the notes stop mattering. Then the trader is no longer operating inside a process, but inside a mood with a platform attached. Build the routine before you need it. Let it carry the dull parts of the day. Let it decide what deserves attention and what does not. The more structure you bring to waiting, the less often waiting turns into interference. And that matters even more once you are already in a trade, because boredom does not disappear after entry, it simply changes its target. Boredom does not end when you enter a trade. In many cases it becomes sharper. Before entry, you are waiting for a reason to act. After entry, you are waiting for the market to prove you right, prove you wrong, or at least do something clear enough to justify your attention. But trades rarely move in a straight line simply because you have taken them. They pause, they hesitate, they test, they breathe. This is where many traders interfere with positions that are still valid. The entry was sound, the risk was known, and the idea still has room to develop. Yet the trader grows impatient because price is not moving quickly enough. He begins to read ordinary hesitation as weakness.